In this video, we'll look at how Bitcoin works, compare it to gold and traditional currencies, learn why Bitcoin is virtually indestructible, and explore why some believe its value could bulge to millions per coin. Let's plunge down the Bitcoin rabbit hole. What is Bitcoin and why was it created? Bitcoin is a digital currency that facilitates sending and receiving money online without a third party. Unlike government-issued fiat currencies, Bitcoin is decentralized, meaning no single entity has control over it. Instead, it operates on blockchain technology, a public ledger recording all transactions. Bitcoin runs on a strict set of rules coded into its system. Any alterations to these rules require majority consensus from its users, ensuring a democratic and secure system. Launched on January 3, 2009 by an anonymous figure named Satoshi Nakamoto, Bitcoin's goal was to create a system of money free from centralized control, and it has a supply limit of 21 million coins. This built-in limitation makes it a more reliable long-term store of value compared to fiat currencies, which have no supply limit and can be produced at no cost. Since Bitcoin is a new thing, how can we rank it relative to other forms of money? To better understand Bitcoin and compare it with traditional currencies and other historical forms of money such as gold, let's analyze it using the primary properties of money. Number 1. Money should be easily divided into smaller units of value. One Bitcoin is divisible into 100 million units called satoshis, or sats. This is much like how $1 is divisible into 100 pennies. Gold, while technically divisible, would require shaving particles of gold off of coins or bars, which would be a complete pain in the ass. Number 2. Durability. Money should not be easily destructible. Bitcoin, which lives on tens of thousands of computers worldwide, cannot be destroyed. Similarly, gold is known for its durability. Both are more enduring than physical cash, which can be shredded or incinerated. Number 3. Money needs to be easily transportable. Any amount of Bitcoin can be sent globally in minutes at a low cost. This surpasses fiat currency, which involves fees, days of processing, no weekend payments, and potential questioning or denial. Gold is also difficult to transport, especially in large quantities. Number 4. Fungibility. One unit of money must be interchangeable with another. Bitcoin units are consistent and interchangeable, comparable to fiat and pure gold. Number 5. Money must be limited in supply, or hard and costly to produce to maintain its value long term. The supply of Bitcoin is capped at 21 million coins, making it scarcer than fiat currency, which has no supply limit and can be created without cost, and gold, whose supply increases at a steady rate and is produced faster when the price increases. Number 6. It must be easy to check whether the money is genuine or fake. Bitcoin transactions are easily validated on the blockchain, offering an advantage over fiat and gold, which require physical scrutiny or third-party verification. Unlike fiat and gold, Bitcoin cannot be counterfeited. To sum it up, Bitcoin scores higher than fiat and gold in many of these properties, making it an arguably better form of money. In fairness, one thing Bitcoin lacks is a long track record, as it's only 15 years old. But in its 15-year history, the network has been functioning properly nearly flawlessly, with the exception of a few hiccups early on. Since 2013, the network has experienced 100% uptime. Bitcoin's supply is limited to 21 million coins, and the creation of new units follows a predictable path. New Bitcoins are produced via a method known as mining. In this process, specialized computers use their computing power to validate new blocks of transactions and add them to the blockchain. For their efforts in supporting the network, they receive newly created Bitcoin and transaction fees when validating blocks of transactions. Initially, miners were rewarded 50 BTC per block, but this reward halves approximately every 4 years, reducing the rate at which Bitcoins are created and increase the total supply. This process, known as the halving, ensures that the total supply will never exceed 21 million Bitcoins. We can predict with high accuracy how much Bitcoin will be created over any period, providing a stark contrast to fiat or gold, whose supplies can be unpredictable. Now, how exactly do Bitcoin transactions work? Sending Bitcoin is kind of like sending an email. You specify a recipient's Bitcoin address, comparable to an email address, and the amount of Bitcoin to send, comparable to the message. The transaction is then broadcasted to the Bitcoin network. Here, computers storing copies of the complete Bitcoin transaction history validate it to ensure you have sufficient Bitcoin to spend. Miners then collect these new transactions and include them in new blocks, which are added to the blockchain or Bitcoin's transaction history. Once a transaction is included in a block, it receives one confirmation. Each subsequent block adds another confirmation. For large transactions, it is recommended to wait for at least 6 confirmations to ensure they are considered irreversible and final. On average, new blocks of transactions are added to the chain every 10 minutes, which is part of Bitcoin's original design. Cryptography is a method of protecting information, and in Bitcoin, it involves the use of cryptographic keys. Consider your Bitcoin wallet as a bank account. The public key is like your account number, which is safe to share with others and can receive Bitcoin. Conversely, the private key is like the PIN that allows spending from your bank account. It's crucial to keep this key secure, because if someone else gets it, they'll drain you of all your Bitcoin. Every time you make a Bitcoin transaction, your private key is used to create a digital signature. This signature is unique to your transaction and can be verified by the network using your public key. The verification process ensures that the transaction was indeed authorized by the owner of the private key, proving ownership of the coins. While the public key can verify the digital signature, it cannot be used to derive the private key. Bitcoiners can manage their private keys in several ways. Many people store their Bitcoin on centralized exchanges such as Coinbase, where the exchange holds your private key. This approach simplifies the process for you, but it also means you don't truly control the Bitcoin. There's a saying that goes, "Not your keys, not your coins." Holding your Bitcoin on exchanges for the long term contradicts the fundamental purpose of Bitcoin. Hardware wallets are a reliable choice for storing your private keys. These physical devices keep your private key offline, providing security against hacks. A seed phrase, which is a list of 12 to 24 words, can be used to back up a private key, enabling secure and portable access to your Bitcoin. The most hardcore of users might memorize their 12 to 24 word seed phrase or employ imaginative methods to store them without using any physical devices. Lastly, to eliminate single points of failure, multi-signature wallets can be used. These wallets require multiple keys for authorizing transactions, similar to high-security vaults. Multi-signature wallets are ideal for storing large amounts of Bitcoin for the long term, akin to burying piles of gold deep in the ground. Similar to a multi-sig wallet setup, Bitcoin itself is nearly impossible to destroy. Let's talk about why. A common question is, since Bitcoin is digital and based on code, can't it be erased or hacked easily? The answer is no. Bitcoin's decentralized structure makes it insanely resilient. The Bitcoin network is comprised of tens of thousands of computers worldwide. Imagine a global ledger with copies kept in thousands of locations. To destroy Bitcoin's transaction history and render it worthless, an attacker would need to delete all copies of the ledger simultaneously, a practically impossible feat. When it comes to Bitcoin's code, it's open source, meaning anyone can view, verify, and propose changes. However, implementing changes requires consensus from the majority of the network participants. Think of it as rules of a game that can only be changed if the majority of players agree. And since users hold wealth in Bitcoin, they have a vested interest in preserving its value and would resist changes that could devalue their holdings, such as increasing the maximum supply. This process protects Bitcoin from arbitrary changes and maintains its integrity. In contrast, the value of fiat currencies held by billions of people are affected by the decisions of a small group in control. Realizing that Bitcoin is resilient to destruction and decentralized in control helped me feel comfortable with the idea of holding it long-term. Holding Bitcoin long-term has several advantages. Bitcoin's scarcity and fixed supply safeguard wealth against monetary inflation. When governments print money, values of items priced in that currency increase, especially scarce assets. As a store of value asset with unique properties, Bitcoin could take market share from other store of value assets like stocks, gold, real estate, bonds, and money. Even a small percentage share from these assets would cause Bitcoin to rip a hole in the atmosphere and take a trip to the moon. For instance, the combined market value of real estate, stocks, gold, and bonds is over 500 trillion. With a current market value of around 1.5 trillion, Bitcoin's upside potential is massive. So how could Bitcoin get to $1 million a coin? Since Bitcoin receives high marks in the properties of money, it makes logical sense that as people learn about its advantages, value will flow to it from inferior forms of money and other stores of value over time. Consider a scenario where Bitcoin captures a portion of various major asset classes: 50% of gold's market value, 5% of the stock market, 1% of the real estate market, and 5% of the bond market. Using these roughly estimated market values, this would give Bitcoin a total market valuation of 21 trillion greenbacks. Divided by 21 million, we get a price of 1 milli a coin. Change these figures as you'd like. But the point is clear. Bitcoin presents absolutely psychotic upside potential relative to the downside. When allocating money to Bitcoin, the longer the holding period, the better. I ran the compound annual return data from 2014 to present. Over 4-year holding periods, the worst 4-year compound annual return was a positive 24%. The data highlights that holding Bitcoin for the long term has generated strong returns historically, but in the short term, Bitcoin can experience 20 or 30% dips quite frequently. So what's the best way to buy Bitcoin? As of January 2024, Bitcoin now has ETFs available for investors to easily access investment exposure to Bitcoin. While purchasing an ETF provides an easy method to gain investment exposure, it removes important benefits of Bitcoin. These benefits include using it for future transactions, storing value independent of third parties, and holding it without incurring fees. I prefer holding Bitcoin directly, but using ETFs is a convenient starting point for beginners and provides access to Bitcoin in retirement accounts that wouldn't be able to access it otherwise. Real Bitcoin can be bought with various platforms. I recommend and use River, a Bitcoin-only platform known for its free recurring buys, automatic withdrawals to cold storage, and focus on security. While exchanges make it easy to buy and sell Bitcoin, they are not recommended for long-term storage. By storing your Bitcoin using a hardware wallet setup, you eliminate the risks associated with leaving your assets on an exchange, such as hacks or fraud, as we saw numerous times in recent years. My friends, deeply understanding Bitcoin takes hundreds of hours, and the journey never truly ends. This guide was meant to be a quick introduction to get you started. I've left links to some great resources in the description below if you want to plunge down the Bitcoin rabbit hole. My name is Wealthmore, and I'll see you in the next one.
Which one's the best crypto asset? Well, Bitcoin's the best crypto asset. Okay. What's the second best? There is no second best. There is no second best crypto asset. There's a crypto asset. It's called Bitcoin, right?